Hey, this is Rene, welcome back for another video on this channel. In the last video, I asked if you want to see a video about the risk management in my 50K account. And the last video is not even online, but I'm still already recording this video because no matter what you say, I think it's kind of important that I talk about this topic a bit. Or actually, I just want to share my risk management with you guys to also hear your feedback in the comments and to hear about what you think. And actually, I just made some changes yesterday to the account, so let's talk about this. So when we talk about risk management, I think we first of all have to talk about like what different strategies I trade. And right now I trade three different strategies. I trade my go long strategy, I trade my turnaround Tuesday strategy, these strategies are not my strategies, they are well-known strategies that many traders use, but I trade the go long strategy, the turnaround Tuesday strategy, and the range breakout strategy. I trade go long in DE40, US 30, US Tech. I trade turnaround Tuesday in DE40, US 30, US Tech, and I trade range breakout strategy in US 30 and DE40. So you can see these indices have the most impact pretty much on this account. This is nearly guaranteed. So in this video, I want to explain why I still think it is okay like this. And then I also have the range breakout expert advisor in USD, Japanese yen, euro, US dollar, GBP, US dollar, and then also in gold since today. So the one strategy that is the most leveraged, where I risk most and which will pretty surely have the highest impact on this account overall is for sure my go long strategy. I made a separate video for this strategy if you are interested and if you want to know how it works. But in a nutshell, this strategy is a strategy that tries to follow the overall development of a index. So for example, this is the German index, or let's go to the US index because most people won't come or won't live in Germany that watch this video, so maybe you cannot really relate to the German index, but this is the US index. So essentially I'm just trading the index price. So I hope that in 1 year, in 2 years, in 3 years, or in 10 years, the index price will be higher than it is today at this point. So every day in the morning, the strategy buys, in the evening, the position is closed. That's pretty much it. And if we have a look at my settings, you can see the risk percentage is 100. So with every single trade, I'm risking 100% of my account. So actually, I kind of have a risk of 50,000 US dollar on every single of these trades, because I also do not use a stop loss. So what the expert advisor, what the program does is it calculates the position size. So if this market would drop to zero on one single day, I would lose 50,000 US dollar because all of the risk calculations are done on 50,000 US dollar or euro in this case. So why do I risk my whole account on this strategy? And I'm not only doing this in this strategy or in this chart, I'm also doing the same thing in the German index, and I'm also doing the same thing in the US Tech index, the Nasdaq. And this is a lot of risk. But if we think about it, I was asking myself the question, how much risk can I go here? And I decided to go with this risk. And I want to explain why. Because in my opinion, or what I believe is that it is, of course, highly unrealistic that these markets or the price in these symbols would drop to zero in one day. I mean, it's not possible, kinda. I mean, there's always like a chance that there is some stars falling from the sky and it's hitting the world and we all die, and I don't know, then the index would drop to zero maybe. But on the other hand, if the indices drop to zero, I don't care about my 50K account. In this case, we will all have other problems that are way bigger than my trading account here. So this is why I'm absolutely fine with risking everything pretty much on every single trade here. So what I expect is, and of course what the history has shown is that on average the daily fluctuation in these symbols or in these indices would be like 1%, maybe 1.5 on average. So what I might lose here is on a normal bad day is like 1 or 2K. This would be a typical kind of bad day if I trade one trade in all of these indices. If I have a very bad day, I could, of course, the indices could go down like 5% on one single day. This would be a very bad day, I would say. I mean, there could be exceptions. There could be days when the indices lose 10%. I don't know. There could be reasons for this. But it's, in my opinion, not super, or the chances are not super high that I would lose 10%. So let's say I lose 5% in all of these three charts on one single day. It would be 15% on my 50K account, which would be 7.5K. Wait, am I calculating this correctly? I don't think so. But yeah, 15K of 100 would, yeah, I mean, it's right. So it would be 7.5K on a like really, really, really bad day. And I think we can all agree that losing 5% in the major indices would be a very, very bad day for the stock market. So this is why I trade with this kind of risk in these charts with this strategy. And on the other hand, having a lot of risk also means that if there are very, very good days in this account, I could also benefit from this, like on a huge scale. So this is why I'm trading this specific amount of risk in these accounts. Then I also have the turnaround Tuesday strategy, and I trade this. And I also have one open trade right now here in the US 30. This is why we can see two trades. And you can see the turnaround Tuesday trade, it has like currently it has the exact same risk settings, or it had the exact same risk settings until yesterday. So the open trade that we can see, it is also opened with like 1.3 lots, which means that it's like 100% risk in US 30. But yesterday, after this trade was opened, I reduced the risk for this specific strategy to 50%. So the next time this strategy will open a position, it will only be half the size of the go long strategy. And this is like only for the reason that, of course, if I have open positions in multiple charts, like we see today, it's even more leverage pretty much on the indices. And I'm even more dependent on increasing indices prices to be profitable on this specific day. So this is why for the turnaround Tuesday strategy in all of these three charts here, I'm now trading with 50% risk instead of 100. So I reduced this a bit to just reduce the risk. And this will also limit my upside potential, of course, but yeah, I cannot risk too much. I feel like I'm already at the upper side of what I'm willing to risk with my account here, because if I risk even more, it would not really be suitable for, I think, my personal acceptance for risk. And yeah, this is why I trade like this in the go long strategy and the turnaround Tuesday strategy. So we already covered the first column here and the third column pretty much. Now we also have the range breakout strategy. And the range breakout strategy is the strategy that is now completely, or that has no correlation with the go long and the turnaround Tuesday strategy. These two strategies that I explained until now, they have a very, very high correlation because they only go long, they only trade the indices. So if the indices go down, I pretty much lose. There's no way I make money in decreasing indice prices with these strategies. But that's why I have the range breakout strategy. And I hope that the range breakout strategy can give some, or it might generate some profits if I'm losing money with the go long or the turnaround Tuesday strategy. So here I'm trading the range breakout strategy in USD Japanese yen, in Euro US dollar, in GBP US dollar, also in DE40 and US 30. So this is again, these are again the indices, but this there's one important difference here. Here I am, wait, why are the trades? These are not the range breakout trades. Okay, here for the range breakout strategy in the indices, I can also take short trades. So if there are bad days in the indices, I might be invested in the go long strategy, but I might also have a short trade on the other side in the range breakout strategy. So this could function a little bit as a hedge. And I'm very curious how this looks in a drawdown period or when the markets come down. This will be very interesting to see. So this is why I trade the range breakout strategy. Maybe as a little bit of a hedge for the go long strategy, so I can make money also in markets that are not going up. So here in the USD Japanese yen, I'm trading with 0.5% risk, and the SL percentage is 0.5% of the current exchange rate here in this pair. So I'm kind of risking, like, if the currency pair goes up 0.5% or down 0.5%, I'm losing 0.5% on the account. And in Euro US dollar, or let's start with GBP US dollar, here it's the same. Here I'm also having 0.5, 0.5, so it's the same. And there's a difference in Euro US dollar because here I'm risking 1%. And why am I doing this? I'm risking 1% here because I also have a larger or more distant stop loss in Euro US dollar. Here I use a stop loss of 1% on the currency price or exchange rate. So if the Euro US dollar moves 1% up or down and I'm invested in the opposite direction, I will lose 1%. And I did this so that the risk that I take is not like bound or connected to one trade only, but also to the overall change in the currency pair. So it's like, if the currency pair changes 1%, I will benefit 1%, or I might lose 1%. So it's the same in Euro US dollar and US dollar Japanese yen. If USD Japanese yen goes up 1%, I will make 1%. But if it goes down 1%, I will, in the best case, only lose 0.5% because I have the stop loss here. But the leverage is the same in USD Japanese yen, Euro US dollar, and GBP US dollar. So this is why I trade it like this here. So the last thing, or the second last thing that I can explain now is the risk in my range breakout strategy trading DE40 and US 30. Here again, I have a little bit different risk approach because here I trade pretty much the same. The concept is the same as in the currencies, as I explained before, but here I'm trading half the risk. So if the index price changes by 1.5% in DE40, I want to risk only 0.75% in the account. And also in US 30, if the price changes 0.5% in the index, I want to lose only 0.25% in the account. So the overall leverage, so to say, in the US 30 and DE40 range breakout strategy is smaller compared to the leverage that I use in the Forex pairs. And the reason for this is simply because I am trading so many different strategies in the US 30 and the and the DE40. So if I have or if the market goes up in the morning, I might have, like in the worst case, I might have 3 open positions in US 30 and or DE40. So for this reason, I just decreased the risk, as I said before, in the Turnaround Tuesday strategy and also in the range breakout strategy, because I do not want to like crazily over leverage. I mean, I might still be over leveraged in these index markets or index CFDs. But this is also for the reason that I believe the go long strategy is maybe the strategy that I have most trust in, if I can say so. It's just because this strategy is really like, in my mind, it's so logical. Like in my mind, it's, I don't know. I mean, the markets might be sideways for 10 years. They might go down for 5 or 6, 7, maybe also 10 years. But in the end, in my head, I deeply believe that at some point in the future, we will see higher index prices. So personally for me, and this is of course no advice, no financial advice at any point. So personally for me, I feel like it's okay to go a little bit more risk in this go long strategy, because for me personally, it's so logical. And this is a bet that I'm willing to take. This is okay for my personal risk feeling. And you have to ask yourself these questions. If it would be also okay for you. And this is something I cannot answer for you. So the last one that I just started trading today is gold. And here I'm trading a similar approach as in the currency pairs. Here I'm also going like 1% stop loss of the gold price. And then this would mean a or a loss of 1%. So kind of the same leverage that I use in the currency pairs, and only for the reason that this strategy should not be correlated. There should be no correlation between the range breakout in gold and the trading that I do in these indices. So yeah, this is the overview over my current setup, my portfolio, my risk here in the 50K account. And yeah, let me know what you think. So far, I'm kind of happy with this. I feel like this is a risk that I am able to take without putting too much mental stress on myself. I mean, I already had this 6K drawdown, and I gotta be honest, it sucked. It didn't feel good, but it was not like I felt my life would slip out of my hand. I mean, drawdowns are always bad, but they should not have too much impact on your mental. And yeah, so this is why I choose this specific setup. Let me know what you think. Do you think I still over leverage the indices? And yeah, if you would do something differently, let me know. So this is it for the overview of my risk settings, or my risk in this portfolio, and I'm out. Yeah, good trades. See you next time. Bye-bye.